It's a really interesting time in the market right now. I think having multiple tools in your tool belt to try to take advantage of that is important. I think a major theme right now is at times it's better to be a borrower than a lender. At times it's better to be a lender than a borrower. Said another way, the credit markets are priced more attractively or more interestingly than the equity markets. And so one of the themes that we've been doing right now is a lot of structured deals where we can get our opportunistic return, but do that with some equity subordination, kind of finding capital market solutions. That is definitely one theme that we're seeing. I think you're seeing things in each of the sectors where there still remains pockets of opportunity. For example, in the hospitality space, you truly are seeing a recovery and a faster rate of growth in urban and group hotels right now. And I think that trend, even if we have a hiccup on the economy for a little bit, should continue. To give you a sense, their occupancy is still over 10 points below where it was. That gives you some optionality potentially to improve. And I think you can go across some of the other asset classes and see those pockets as well. Example still in industrial is some of the smaller bay assets, 300,000 square foot projects that could be multi-tenanted or under. Demand remains very strong. That's very different than the million square foot big box distribution. So we see a lot of different opportunities right now with the overlay knowing that the credit markets are quite challenged. So the multifamily space is very interesting right now. Multifamily historically is traded at a much lower cap rate than real estate broadly. Because of that, and regardless of top line performance, it's going to have a greater impact, the interest rate moves that have occurred on a low cap rate asset. And so even very good assets, very strong performing assets are going to have major problems. If you take an asset that was acquired in 2019 or 2020, and if it was doing $1 million of income, let's say it had debt service, it had a 300 basis point rate loan, and as we know, treasuries were basically nothing. Today, that cost of capital is effectively double. And so if income stayed flat, you're literally going to have roughly half the proceeds of debt that you would. It means income has not stayed flat, but you would have to have such a large increase in income over such a short period of time to not have a funding gap. And so what's likely going to occur on those strong performing assets is there's going to be a major equity need to pay down loans. And that is going to be something that is going to create congestion in the broader capital markets and is going to need to find solutions to kind of come through that. The other thing you're seeing, if you have a very long-term view, which is a positive, is because of the challenges in the capital markets, construction starts are absolutely declining. And so the overall construction starts are below 2% for across the country right now, which should be a setup from a very long-term view about a healthy apartment market. Where are the jobs today? It's tricky. I will tell you, when I graduated, it was not a great real estate market. It was right around the tech wreck, just before it actually. And not many people wanted to be in real estate. They all wanted to go work for whatever the next new tech company was. Today, I think there are a lot of opportunities, but it's a softer job market. In my opinion, you need to think about zigging where others are zagging to find opportunities and really think long-term about what's going to provide you the best experience. Many of the mega cap name brand firms, whether they are the big banks, the mega cap private equity funds, some of the big consultants, they have a very prescriptive approach to hiring. and they've extended their view of that, so they're doing job offers 12, 18 months out. They've already committed in many ways, and in many instances overcommitted for the next year. There are a lot of extraordinarily high quality mid to smaller firms that in many times can actually create an even better experience because you have even more boots on the ground, have more exposure to things. They have more just-in-time hiring. I think that is where both you can have a great opportunity and experience and probably more fruitful hunting ground for jobs. The other area I would mention is there's a lot of really fast-growing niche sectors. It's not even fair to call them niches anymore. And that includes the towers, the data centers. Senior housing still has a lot of that going on. Cold storage, industrial outdoor storage. Gaming is still growing. The entertainment space and the real estate with mixed use around that, there's many firms. These are mega trends. Life science is another example. These are mega trends that you're seeing soak up a lot of incremental real estate capital, but they haven't built out their infrastructure for that. And I think there's a lot of tailwinds if you look out going to one of those firms or having exposure to that over the next 5, 10 years.